ever try to, like, predict the stock market?
Hmm.
It can feel like, I don't know, trying to predict the weather, like, 3 months out.
Right. Total shot in the dark.
Yeah. Well, maybe today's deep dive can, give us a bit of a leg up on that. We're going to try to decode the Fed's recent interest rate cut
Okay.
and how that could impact your investments. Because, as you know, everything's connected.
It's a topic with a lot of moving parts, for sure.
Yeah, for sure. And we're all about giving you that shortcut to being well-informed.
Absolutely.
So we're diving into this article. It's called The Impact of the Federal Reserve's Rate Cut on the Stock Market.
Okay.
Packed with insights. But we're here to pull out, like, I don't know, the most interesting
Yeah.
and useful stuff for you.
For sure. Let's break it down.
Okay. So the article kicks off talking about the Fed. Okay. And they kind of describe them as, like, this economic chef trying to cook up this perfect economic dish. And they're using interest rates as their, like, secret ingredient.
Right.
What do you make of that analogy? I actually think it's quite apt. They're trying to get the economy simmering, right? Not too hot, not too cold, just right. And when inflation was so high last year, they raised rates, cooled things down a bit. And now with things slowing down, they've cut rates to try and encourage spending and investment. Which makes this latest rate cut so interesting because they've been increasing rates, right?
Right.
And now this cut has everyone wondering, like, is this a sign the economy's actually in trouble?
Yeah, it's a big question on everyone's mind. And the article, it suggests we look at past rate cuts for clues. But it's not as simple as saying rate cut then equals boom or rate cut equals bust. It's all about context.
Right.
You have to look at the bigger picture.
And they had some pretty wild examples in there.
Oh, yeah.
Like in '87, a rate cut happened and the market rallied like nobody's business.
Yeah.
But then 2007, another rate cut.
Right.
And, well,
Not so much.
not so much. We all know what happened then. The biggest financial crisis since the Great Depression.
Exactly. And that's why understanding the why behind the Fed's decision is so important. In 2007, that rate cut, it was a response to a housing bubble that was already bursting.
Oh, okay.
It wasn't enough to stop the domino effect that had already begun.
So it's like trying to put out a fire when it's already, spread throughout the house.
Exactly.
You need more than just a cup of water at that point.
Yeah, you need a whole fire department at that point.
Right, right.
And this is where I think understanding a bit of technical analysis comes in handy, which the article also gets into.
Okay, yeah. They mentioned the S&P 500, which I know is like this big, important stock market index.
Yeah, think of it as a snapshot of how well 500 of the largest U.S. companies are doing overall.
Okay, right. So they talk about how the S&P 500 is currently above its trend line, and they say that's a good sign. Can you, unpack that a little bit for us?
Absolutely. Imagine you're drawing a line connecting the lows of the S&P 500 on a chart over, say, a year. That's your trend line. As long as the index is dancing above that line, suggests the market's in an uptrend, meaning there's generally more buying than selling.
Okay. That makes sense. But then they mentioned support levels, and that if the S&P 500 breaks below those, it could signal a downturn.
Right, support levels, think of them like floors on a chart. They're price levels where the S&P 500 has historically bounced back up from.
Yeah.
If we start seeing the index consistently closing below these levels, it could mean the buyers are losing steam. And a downtrend, a bear market, might be in the cards.
So it's almost like the market's saying, hold on, we need to regain our footing here,
Yeah.
or else things could get a little shaky.
Exactly.
And the article really highlights how the coming weeks are critical for this very reason.
They are. Big decisions to be made.
Yeah. And this is where it gets, I think, really actionable for our listener. Because if the market stays strong and holds above those support levels, the article suggests we could be looking at a bull market.
Potentially.
Yeah, kind of like that 1987 scenario.
Could be.
But we also need to be prepared for the other side of the coin, right?
Always. Got to be ready for anything.
Because if those support levels crumble
Yeah.
and we start seeing the market consistently close below them,
Could be a sign.
that's a warning sign, right?
Uh-huh.
Could signal a bear market similar to 2001 or even 2007.
Precisely. And again, it's not about panicking. It's about being informed, being prepared. Keep an eye on what the market does over the next few weeks.
Yeah.
Is it staying strong or showing signs of weakness? Your investments might thank you for it.
Yeah, knowledge is power, right? That's what they say. And while the article focuses on the technical analysis and historical parallels, I'm wondering, what other factors are you paying attention to right now that could, throw the market a curveball?
That's a great question. Geopolitical events, Those are always a wild card.
Right.
And we've seen some major ones recently, and those can definitely send ripples through the market. Also, keep an eye on any big technological innovations. Those can disrupt entire industries practically overnight.
It's a lot to keep track of. It really highlights how important it is to, I don't know, stay curious, keep learning, and be ready to adapt your investment strategy.
Couldn't agree more. The market rewards those who are adaptable and informed.
Excellent food for thought. For everyone listening, we hope this deep dive gave you some valuable insights. Remember, the market's always got a few surprises up its sleeve, so stay informed and happy investing.
To your success.